All right, so for those of you who don't know me, my name is Carolyn Keller, and I am the founder of Curio 412. We are a organizational development consulting firm for both for-profits and nonprofits with charitable initiatives, and we help with impact management. So making sure that you have the outcomes in mind that you want and a great way to measure and track them so that you can make them even more impactful within the communities in which you work. And so one of the ways that we do that is by providing these next step sessions where we bring in some experts from different areas just to discuss some of the issues that you might be dealing with. And so we have TJ Drost with us today from Fragasso Financial Advisors, and he's going to be talking a little bit about investment policies and investing for your organization, what that looks like and what it means. And you might have some other surprises for us too, but I'll let you take it away and introduce yourself, and I'll go ahead and pull up your slides.
Well, thank you for the introduction, Carolyn. But again, I'm TJ Drost. I'm the institutional assets manager at Fragasso Financial Advisors. My role at the firm is to focus on servicing our nonprofit clients and helping them fulfill their fiduciary responsibilities. So today we'll be looking at investment policy essentials. This is in no way an exhaustive list of things for an investment policy, but I think it'll give you appropriate guidance on those things that you should be certainly including in the investment policy. And I try to recommend to any nonprofit organization who's looking to establish an account or an endowment that it really makes sense to have this in place. It protects you, and it also is going to provide the framework of how the investment will work for the organization. So, Carolyn, if you could flip to the next slide, please. So, first of all, what is an investment policy statement? So, an IPS is a document that establishes the purpose for the funds, along with the long-term goals and investment guidelines for an organization. And this is typically created by the investment committee and or the board of directors or board of trustees. The document provides the investment manager with the ground rules and provides direction on how the investment manager should invest and track the investments in order to reach the nonprofit's particular long-term goals. So you can go ahead and flip to the next page, please. So along with purpose of the funds, it's important to lay out the investment objectives and spending policy within the investment policy statement. So again, this is going to help guide that investment manager on the selection of the funds based upon the risk propensity of that organization. The second item, which is in the middle, deals with tax management. And, when we think about nonprofits, we typically, for the most part, they're tax-free entities. But as we meet with prospective clients, it's not unusual for us to see their holdings, and these nonprofit prospective clients or clients, they may have funds that are invested in things that are probably not the most appropriate given from a taxation standpoint. They might be in municipal bonds, they might be in tax-free money markets, they might be in tax-managed mutual funds. Since the nonprofits already afforded that tax-free status, by being in those types of investments, they're actually losing some performance because they could take advantage of regular investments that typically are going to give you a little bit more growth than what a tax-managed investment might. And then also, when we talk about investment objectives and how that relates to the investment policy, your investment policy should clearly spell out the anticipated annual withdrawals that the organization is going to need. So typically the way I see this, it's either an annual percentage. Most commonly, it's around 5% or less, or in some cases, we'll see it as a flat dollar amount. I'm thinking one off the top of my head, they might need $200,000 every year. But it should be in the document. That way it provides clarity on the assets that are going to be needed, and it also help the investment advisor on a selection of investments that they might be looking to distribute throughout that year to the organization. So you can move to the next slide, please.
And TJ, how large are the organizations that typically come to you, or when do you anticipate organizations getting large enough that they need investment policies like this?
Again, when we talk about that, you know, I have a nice little chart that I'll send you, Carolyn, that you can share with everyone. But, you know, when we start having that thought of opening an account or maybe starting an endowment fund, I think there's some important elements that you have to consider. I think one, you need to have checking and money markets available for cash for daily operations for those types of organizations. The next thing, as far as capital needed for the upcoming year, I think you have to have money market accounts or short-term CDs to kind of meet those needs. When you begin to have surplus capital, that's when it starts to make sense to think about opening some type of investment account or some type of endowment account. Now, endowments get tricky because a lot of the time, I don't want to say a lot of the times, but there's some thought process that you know, folks in the organization may say, we should be doing more with what we have today to satisfy the needs that we have. So sometimes getting everybody on board to start the endowment can be a little bit difficult. So, but I think trying to hold those parameters, make sure you have enough for your daily expenses, make sure you have enough for, you know, the next year or two. When we start getting that surplus area, that's when it makes sense to start considering some type of investment account or endowment, depending on the needs of the organization. So great question, Karen. Thanks. So here we're going to look at asset allocation. Certainly, your investment policy statement should provide for a range of a broad mix of assets for helping the organization achieve their goals. So here on this slide, what we have is, it's literally, I lifted this out of an investment policy statement that we have for a client. You'll see down the middle, we have a normal position. So in this particular example, this organization is utilizing a 60% stock, 40% bond type of allocation. In normal times, and you know what the investment advisor is going to do, they're going to rebalance to this position throughout the year. There might be a little bit of variance. You know, if the stock total goes to 65 and the fixed income portion goes to 35, they may let that go for a little bit. But in the end, at some point, this will get rebalanced back to that normal position. You'll notice to the left and to the right of the normal position, we have a minimum and a maximum. I think it's important to note, it's good to give the investment advisor a little bit of latitude for short-term tactical type of decisions. But, you know, very rarely will an advisor go to that minimum or maximum position. We're talking probably you know, at most maybe a 10% variance from that normal position. But if we look back to last year in the time period of February through March, you know, stocks really went down in value. There was a complete sell-off, bonds appreciated. But what happened after June 30th is you really saw stocks take hold. Those are the decisions for the advisor maybe to make tactical decisions, maybe overweight some stock portion a little bit, or in the event that markets aren't going the right way, maybe overweight the bond position. So again, it's those tactical decisions, but more than likely, this normal position right down the middle is where this portfolio should remain and should be as far as management is concerned. So you can flip to the next slide. Benchmarking, certainly each investment asset class that you have should be lined up to the specific indice that matches up to that. So again, I extracted this just from some of our investment policy statements that we have with clients, but these are pretty general benchmarks or indices. So, you know, the first one's the S&P 500. That's going to track domestic large cap equities. The next one down is the Russell 2500. That's going to track small and mid-sized US companies. The next one's MSCI EFA. That's going to be developed international. So it's going to be Europe, Australia, Far East. So that'll be, stocks like Toyota, Honda, Nestle. Below that is MSCI emerging markets. That's going to be Brazil, Russia, India, China. For fixed income, we use Barclays US Aggregate Bond Index. So you're looking at like 5 to 10 year maturities on those bonds. And lastly, we have the Citigroup 3-month Treasury Bill Index, which that's going to be your short-term investments. What that's going to line up to are your money markets. So along with these individual indexes for each asset category, if you're working with a financial advisor, they should be creating a custom benchmark to compare your portfolio against. So in the example that we talked about earlier, we talked about a 60% stock, 40% bond portfolio. So that custom index, and I'm just throwing this out there, might look like 40% in the S&P 500, 10% in the Russell 2500, 10% in the MSCI EFA, and then 40% in the Barclays US Aggregate Bond Index. So when organizations are comparing performance of their account to that custom benchmark, sometimes it's going to mirror that. It should be really pretty close. There will be times where maybe your portfolio is going to outperform that index. There's going to be times where it may underperform, but certainly your financial advisor should be able to provide you with insight into those reasons. And if there's adjustments that are needed, they'll provide that advice as well. I think it's a good idea to include prohibited investments or investments that the organization will require board approval for before implementation. Again, took this right from some of the investment policy statements that we have for our clients. And, when we look at this list of investments, some of them are a bit speculative. I mean, venture capital, commodities, precious metals and gems, options and short selling. Probably, when we look at a nonprofit endowment or just a nonprofit investment account, we're usually looking at this as, a perpetuity. We want this account to last, forever. We don't want to take too much risk, but we want to make sure we're taking enough risk to outpace inflation and to grow these assets over time. So one of the common concerns with some of these prohibited investments that we listed here is that maybe they only have limited liquidity, meaning they're not completely liquid. It may take a few days. It might take 3 months to become liquid. And if you're a nonprofit and if you have a good hunk of your money in these assets and you have withdrawals that you need to make, it may not be in your best interest. So that's why we list those here. We typically don't run into a lot of nonprofits that are interested in utilizing these types of assets, but certainly we leave our ear open to hear what they want to utilize. And if they do, we would certainly come up with ways to make it work. So you can go to the next slide. The investment policy statement should certainly lay out the roles and responsibilities. So this slide here is going to deal with the finance committee's roles and responsibilities. And then I have another slide later on, I think it's next in the deck, that's the investment manager's roles and responsibilities. So you may see some overlap in some of these things, but when it comes down to it, you really want that checks and balances, right? You don't want one party doing everything, and you want to make sure that somebody's keeping their eye on the ball and somebody's also monitoring to make sure that that person's keeping their eye on the ball. So the first item I listed here was evaluate investment for compliance with the investment policy statement. So as a finance committee member, certainly you're going to want to ask yourself, are the investments in my portfolio, when I look at my statement, are these consistent with what the investment policy statement spells out? So, whether it's keep staying away from those prohibited investments, keeping that allocation in line at that 60% stock, 40% bond type of allocation. You certainly want to make sure that the investments remaining within those parameters as outlined in the IPS. So second item is reviewing the costs associated with the management of the portfolio. So here, I think the finance committee usually has a pretty good handle on what the advisor's annual fee is. But I think where it gets a little opaque is the actual average cost of the investments in the portfolio. And, investment committees will have a harder time, finance committee members will have a harder time probably finding out that detail. They should simply reach out to their investment manager, who should be able to provide that pretty quickly to them. And, since the investment advisor has a fiduciary responsibility along with you, they should be looking to be actively reducing those internal costs on their investments. It's the idea that they have to put your needs first, and they should be managing those costs as well. Last item I listed is evaluation of the organization's investment manager performance. So I like this one because, certainly the IPS should state how often the finance committee is going to want to look at that. And I think the automatic thing I always think about is, yeah, they should be doing this quarterly. But for those of you on a nonprofit board, the dynamic of getting people together, even before the pandemic, is challenging. I mean, it's tough to get people together sometimes 1 to 2 times a year. So sometimes quarterly, getting together quarterly and discussing this as a finance committee could be difficult. So I would say for those folks who are on finance committees and you're putting together your investment policy statement, really take a hard look at that and figure out what you think is going to work best for your organization. Your investment manager, they're going to be able to do pretty much whatever you ask of them. So if you decide it's quarterly, they're going to be able to do it. If it's semi-annually, they'll be able to do that. At a minimum, I think you should be reviewing this twice a year, and that's at the extreme minimum. So you can go ahead and flip to the next slide. So this will get into the roles and responsibilities for the investment manager. Again, this type of verbiage should be included in the policy statement. So some of the common language that we see is the portfolio invested within the parameters of the IPS. It's kind of a little bit of a repeat in what we saw in the first slide, but certainly it's the advisor's duty to stay allocated within that normal range. Again, they might make tactical decisions here and there, but they should certainly be adhering to that normal allocation. The IPS should discuss communication and portfolio monitoring guidelines. So I know in a lot of the IPSs that I read, it's going to talk about maybe a certain member of the finance committee will reach out to the firm and have different communication other than just the review of performance. So how our firm responds to that is, if I have a client who I know is going to be making an annual withdrawal, and let's just say in this case it's 5%, what I like to do is provide them with a stress test to see what that distribution might look like if we did it at 3%, 4%, or 5%. And then we put that through Monte Carlo simulation, which, if you're unfamiliar with that term, it's taking this distribution at a different rate during different time intervals and different market conditions over historical returns and different market cycles. So when we provide that kind of data, it'll give the client the idea of what the longevity may be of that asset if they take the distribution at a 3%, 4%, or 5% withdrawal rate. So I think it gives you a lot of confidence. And for planning purposes, I think it's great to have. It's another one of those nice things that as a member of that investment committee, they should tuck this into their fiduciary file in the event that they're ever audited. They can say, look, we're fulfilling our fiduciary role. On top of that, we also like to prepare what's called an investment policy statement and guidelines checklist. So let's face it, an investment policy statement has a lot of language in there that if you're not in it every day, it's not exactly the most user-friendly language. Along with that, I don't know many people who memorize investment policy statements, including myself. So what we like to do is create this checklist where we take the individual nonprofits investment policy statement, we extract the most important details, and then create a checklist so that it's more of an executive summary. You can see that checklist and it's going to tell you right on the front page if you're compliant in 10 to 15 different areas that your investment policy statement outlines. So we think that's a really great thing. It's been met with a lot of great comments by our nonprofit partners. And again, in the event that you're audited, you have this in your fiduciary file. It's showing that you're fulfilling your fiduciary duty as a member of that investment committee. Lastly, review frequency. I know this kind of gets a little bit repetitive from the last slide that we looked at, but if I had my druthers, I think I would like to review all my nonprofit clients' portfolios quarterly. I think that type of interaction works very well. We can see how things are performing. Certainly, we'll be benchmarking the performance to the custom benchmark as well as the different indices. But it really opens up that dialogue too to figure out what the cash needs may be for the next quarter, what it might be down the line. If you are having donors who are making contributions, it really, I think the more frequent that we have communication, the better it is for all the parties involved. But as I stated earlier, that dynamic is tough. Maybe a little bit easier during the Zoom days now because we're not traveling to as many places, but certainly I think just really laying out what you think your organization, what's going to work best for them, whether it's quarterly, semi-annual, or annual. You want to list what's going to work the best for you. So lastly, annual investment policy statement review. So I can't tell you how many times we get a prospective client that comes in and their investment policy statement is 20 years old. Now, that's okay if it's 20 years old, if they're looking at it at least annually and making adjustments as needed. The problem is they're not making adjustments as needed. These become dated documents. So, part of that fiduciary duty for the investment committee is to review this statement at least annually and make sure that it's viable. And if any changes are needed, you should certainly be looking to make those. Now, your investment manager should collaborate with the organization on this investment policy statement because there's a lot of things that maybe the investment committee is not going to know has changed. So, a lot of what I do is work with organizations that I manage on, bringing these up to date, revising these as needed. So in some cases, we're looking at, it could just be convoluted language where it's not real clear. We might make adjustments there. It could be an index. You need to update the index or an index is no longer valid. Like Lehman Brothers was the old bond index. And then after 2008 and 2009, they're out of the picture now. It's now the Barclays aggregate bond index. Some other conversations that we're having, at least over the last 2 years, that are pretty common, it's revolving around getting verbiage in that addresses ESG type investing. And if you're not familiar with that, it stands for environmental, social, governance. So a lot of our nonprofit partners are looking to add verbiage in where they want their investments to be part of companies who are doing things for the environment that are sustainable, doing those things that make sense from a social aspect, but also utilizing companies who have strong governance. Whether that's, when we talk about governance, that could be executive pay, equality across the board, diversity across the board. That's a hot topic now. And that's one thing I can tell you that we've been adding into a lot of investment policy statements in the last 2 years. So, but those are just some examples of things that we're looking at. And, certainly, please look at this annually. If you're working with an advisor, bring them into you shouldn't even have to bring them into the fold. They should be the ones inquiring, saying, have you looked at this investment policy statement? So to summarize, certainly if you're considering opening an account for your nonprofit organization, or if you have one, a lot of these elements, they're going to be integral to having a strong investment policy statement that's going to protect your organization, and it's going to really set the guidelines and the rules for how that investment advisor is going to invest your account. So at this point, Carolyn, just want to thank everybody for their attendance today, and open it up to any questions that anyone may have.
Thanks, TJ. I'm going to go ahead and stop the recording, and I have a few questions for you. Before I do that, though, one is, what are some of the goals that nonprofit organizations have when they come to you that leads them to want to start this investment process?
Certainly. When organizations come to us, typically they're looking to make sure that they're growing these assets down the line. Just the other day, I had a conversation with a nonprofit, and they're like, look, we're planning on building a facility. So we're looking at about a 10-year period. We want to grow these assets, try not to touch them for 10 years, and then apply this to that project. So it's usually, whether it's something in the long term or the midterm, that's usually why organizations are coming to us. There's a lot of PPP money released in the last year. So a lot of organizations have come to us with that PPP money that they received and said, look, we have excess from what we received. We'd like to put this to work by investing it within the parameters of our investment policy statement, and to grow that asset. So down the line, if there's a need, or if we run into trouble, like a lot of nonprofits struggle. I mean, that's not a mystery through last year. It was really tough times. And a lot of folks needed some money to see them through those days. So I think that's on top of a lot of people's minds right now too, is replenishing some of what they may have taken.
No, absolutely. Well, and you were talking about growth over time. How long do nonprofits typically leave this money in order to meet their goals? I'm sure some nonprofits, they have that long-term goal of just continuing to grow, but you talked about liquidity too. So, in the case of something like a capital campaign, what does that typically look like for an organization that has either goals for building capital or goals for meeting some of their organizational goals?
So again, it's more specific to the organization. So, I would say probably out of the 70, I'm just throw this out there, probably 70% of the nonprofits that we manage, they normally have some type of quarterly withdrawal that they're going to do, because it's built in. They say, look, we need a 5% withdrawal rate. That's what we anticipate. So a lot of that, when you start talking endowments, they really can't touch principal. They can only touch the interest on there. So it really depends. I know last year we had an organization that they were kind enough to give us a heads up about 2 years in advance that they're going to be remodeling their offices. That was around a $700,000 bill. So and it afforded us, in a difficult time period with what the markets were doing in 2020 in the first half, as to what they did in the second half, to kind of strategically decide how to raise funds and when to do that. So as far as the cash that's needed and the growth, certainly if you don't need to touch it, it makes sense to just let it go. But it seems like there's usually something that pops up that those funds can be used for.
Always, yeah. And then another question I have is, and I already know the answer to this because I've actually worked with TJ before with another client. But do you need to have these types of statements in place before approaching someone on the investing side, or what should an organization expect when they are thinking about investing? Should they try to put this policy together, or should they start seeking out the expertise of investors or investment advisors?
So I would say this, of the five most recent clients that we brought on, probably two of them had an investment policy statement in place. The other three, we created an investment policy statement for them by really showing them a prototype document that we have based off of some other investment policy statements that clients have utilized. But it gets into a deeper conversation of understanding their needs, what they're looking to do. So I would think that most advisory firms like us are willing to help organizations get that document in place. And it's really important. And it's funny, I was looking at this slide that I told you about this. It gives you, I don't know if you can see it, it gives you a checklist on, when you should start considering an endowment fund. And we have on this form, requires investment policy statement and guidelines. So if the organizations don't have it, we're certainly willing to help them put one together. That way we're safeguarding them as much as we can. And we act in a co-fiduciary, in a co-fiduciary capacity with them. So this is also going to help protect us in that fiduciary role with you.
Thanks, TJ. I'm going to go ahead and stop our recording now and open up to some questions from some of the people here today. But thank you so much for answering my questions and